Ever wondered how the wealthiest individuals seem to navigate the financial landscape with such finesse, maximizing their gains while minimizing their tax burdens? The world of wealth manipulation is intricate, filled with strategies that the affluent employ to stay ahead in the game. However, there's one key aspect often overlooked by many aspiring investors, a secret method that separates the truly successful from the rest. I'm going to unveil this hidden strategy later on. But first, life can feel like a constant battle for those with limited financial resources, where every dollar counts towards survival. Meanwhile, the wealthy seem to play an entirely different game, manipulating money to their advantage in ways that can seem inaccessible to the common person. In this episode, we'll delve into 5 common strategies employed by the affluent to manipulate money, shedding light on a world often obscured from view. Tax optimization. Tax optimization has long been a hallmark of financial strategy, dating back centuries to the days of ancient civilizations where rulers imposed taxes to fund wars and infrastructure projects. In medieval times, wealthy landowners and merchants often navigated intricate tax systems by leveraging their connections and influence. Fast forward to the modern era, and the practice has evolved into a sophisticated game of numbers and regulations, epitomized by figures like Jeff Bezos. Amazon's founder has become synonymous with tax optimization, utilizing a complex web of deductions, credits, and international structures to slash the company's tax bill. In the contemporary landscape, tax optimization isn't merely about minimizing liabilities, but also about maximizing returns on investments. It's a game played by the financially astute, where every deduction and credit is meticulously scrutinized for its potential impact on the bottom line. However, the accessibility of these strategies remains unequal, with corporations and high-net-worth individuals having the resources to employ teams of tax experts and lawyers to navigate the intricacies of the tax code. For the average taxpayer, the avenues for tax optimization are far more limited, highlighting the gaping disparity in the financial playing field. As discussions around wealth inequality intensify, the role of tax optimization and its implications for societal fairness come under increasing scrutiny, challenging the status quo and calling for reforms that promote transparency and equity in the tax system. Offshore accounts and shell companies. Offshore accounts and shell companies have a storied history dating back centuries, often intertwined with tales of intrigue and secrecy. From the medieval merchants of Venice using complex networks of trade routes to evade taxes to the elaborate schemes of Renaissance-era European nobility, the concept of hiding wealth offshore is not a new phenomenon. However, with the advent of modern banking and globalization, the practice has evolved into a sophisticated industry catering to the financial elite. The Panama Papers scandal of 2016 stands as one of the most significant revelations in recent history regarding offshore accounts and shell companies. This massive leak of documents exposed the inner workings of a global network of tax havens and offshore entities, implicating prominent figures from around the world. The Panama Papers shed light on the extent to which individuals and corporations use offshore accounts to conceal assets, evade taxes, and engage in illicit financial activities. The fallout from the scandal reverberated across the globe, sparking investigations, resignations, and calls for greater transparency in financial systems. The Panama Papers served as a wake-up call, illustrating the stark disparities in wealth and access to financial resources between the powerful and the ordinary citizen, prompting a renewed scrutiny of offshore banking practices. High-frequency trading, HFT. In the landscape of modern finance, high-frequency trading, HFT, has emerged as a contentious practice that epitomizes the intersection of technology and wealth. Historically, the evolution of financial markets has been punctuated by transformative innovations, and HFT represents one of the most recent advancements in this continuum. Dating back to the early 2000s, the rise of HFT gained momentum alongside technological developments that enabled split-second transactions. One of the watershed moments in its history came during the flash crash of 2010, a market event that saw a rapid and severe downturn followed by a quick recovery, shedding light on the potential risks associated with high-frequency trading algorithms. Wealthy investors employ sophisticated algorithms and high-frequency trading strategies to gain an edge in financial markets. Through lightning-fast trades, these investors capitalize on minute price discrepancies, a practice far removed from the traditional investment approaches available to the average person. Renaissance Technologies stands as a testament to the success of quantitative trading strategies in generating substantial profits for the wealthy elite. Founded by mathematician James Simons in the late 1970s, Renaissance Technologies pioneered quantitative investing by leveraging complex mathematical models to exploit market inefficiencies. Over the years, the firm's Medallion Fund has delivered unparalleled returns, cementing its reputation as one of the most lucrative investment vehicles in history. The proliferation of HFT reflects a broader trend in finance, where technology and data analytics increasingly shape investment decisions and redefine the dynamics of wealth accumulation. Real estate maneuvering. Real estate maneuvering stands as a testament to the power of strategic financial decisions in shaping personal wealth. Throughout history, notable figures like Donald Trump, prior to his presidency, have exemplified the art of leveraging debt, negotiating advantageous terms, and exploiting market trends to amass vast real estate empires. Trump's journey from real estate magnate to the highest office in the United States underscores the pivotal role of strategic real estate transactions in shaping both personal fortunes and political destinies. However, it's crucial to note that such maneuvers aren't confined to the realm of the ultra-wealthy. Rather, they represent a strategic approach to wealth management that, when executed with precision, can yield significant returns. In the realm of real estate, the ability to identify undervalued properties, negotiate favorable deals, and capitalize on emerging market trends is paramount. From ancient civilizations to modern-day entrepreneurs, the manipulation of real estate assets has been a cornerstone of economic prosperity and power. The Medici family of Renaissance Italy, renowned for their banking prowess and patronage of the arts, strategically invested in real estate properties across Florence, solidifying their influence and legacy. Similarly, in contemporary times, individuals like Donald Trump have demonstrated the transformative potential of real estate maneuvering, reshaping skylines and financial landscapes alike. However, while the allure of real estate investment is undeniable, it requires not only access to significant capital, but also a keen understanding of market dynamics and a willingness to navigate risks with calculated precision. Charitable foundations and trusts. Throughout history, charitable foundations and trusts have played a pivotal role in shaping societies and addressing pressing issues. Dating back to the days of the Medicis in Renaissance Italy, who established philanthropic institutions to support education and the arts, the concept of using wealth for societal betterment has endured through the ages. In the modern era, titans of industry like Andrew Carnegie and John D. Rockefeller pioneered the model of philanthropic foundations, leaving behind a legacy of endowments that continue to fund initiatives in education, healthcare, and research. Charitable foundations and trusts offer a dual-purpose strategy for both philanthropy and wealth manipulation. By donating assets to these entities, individuals can enjoy tax benefits while retaining control over their wealth. The Gates Foundation, founded by Bill and Melinda Gates, exemplifies how the wealthy use philanthropy not only to contribute to social causes, but also to shape their legacies and exert influence. With an endowment exceeding billions of dollars, the Gates Foundation has spearheaded initiatives to combat diseases like malaria and polio, improve access to education, and address global poverty. Moreover, these foundations often serve as platforms for promoting specific agendas, advocating for policy changes, and collaborating with governments and other organizations to drive social change on a global scale. As such, they become powerful agents of influence and drivers of innovation in addressing some of the world's most pressing challenges. Wealth manipulation has been a hallmark of human civilization since ancient times. From the bartering systems of early societies to the sophisticated financial instruments of today, the pursuit of wealth has driven individuals and societies to devise strategies to maximize financial advantage. In ancient Rome, for instance, the wealthy elite engaged in various forms of economic manipulation, including price fixing and monopolistic practices, to consolidate their fortunes and maintain their status. These historical references serve as poignant reminders that the complexities of wealth management have long been intertwined with issues of power, privilege, and morality. In modern times, the landscape of wealth manipulation has evolved to encompass intricate financial instruments, tax optimization strategies, and regulatory loopholes exploited by the affluent to preserve and grow their assets. While some of these tactics may operate within the bounds of legality, others skirt ethical boundaries, perpetuating disparities in wealth distribution and exacerbating socioeconomic inequalities. The call for effective regulations to ensure a fair and transparent financial system has never been more urgent, as the consequences of unchecked wealth manipulation reverberate across economies and societies. As we navigate the intricacies of wealth management in the 21st century, it is imperative that we remain steadfast in our commitment to fostering an equitable distribution of resources and opportunities for all individuals, regardless of their socioeconomic status.